Hey, good
Hey, good
afternoon,
afternoon,
everyone,
everyone,
and thank
and
you
thank
for
you for
participating in
participating
this
in this
webinar.
webinar.
We'll be
We'll be
talking
talking
about
about
the
the
7 steps
7 steps
to
to
financial
financial
freedom.
fitness. Okay, achieving financial fitness requires discipline and determination over the long term, just like running a marathon. I think doing this webinar is actually very appropriate for me because earlier this month, actually earlier last month, I just finished my first marathon. And it really requires, or training for a marathon really requires a lot of discipline and determination, because prior to running this marathon, I've actually been running for more than 5 years. And the training, just deciding to run a marathon, you have to train for it like for more than 6 months to actually be able to finish the whole 42 kilometers of a marathon. So really, it is a long-term endeavor, just like investing. You can't decide that you want to save or invest for something and expect immediate results. It really requires a lot of discipline and determination to meet those goals over time. And of course, as with any type of training, becoming financially fit requires learning the principles and best practices. So again, when you want to run a marathon, you have to have a training program that you need to follow. So to be financially fit, you also need to follow some principles and best practices for you to achieve your goal. So one of the first steps that you need to do to be financially fit is to set financial goals. Okay, first of all, you can't reach your goal if you don't set them. Like if you don't even know why are you investing, um, and what are you investing for, then I think you won't even go out and do it. Okay, planning how to use savings and investments to reach your goal is key. Okay, so one of the things you should do, of course, I mean, before you can make any investment, is of course you have to set aside some funds for it. Or if you spend everything you make um, on a monthly basis, then you can't even make any investments. Also, if you have a goal, but then the goal is so lofty, but you are afraid of, say, investing in more aggressive types of assets such as stocks, then it will be very difficult for you to reach your goal. You have to be able to both grow your savings and be familiar with the different types of investments to reach your goal. Okay, so determine how much you need to save over time to finance your dreams. I guess for me, you have to start with thinking about what your dream is. I mean, what's your goal? Why are you doing this? Like personally for me, when I started my investment journey, I began with a number in mind. Like I said, I want to have a certain amount by the age of 40. Okay, but then over time I realized that rather than just having an amount by a certain age, I wanted to be able to make sure that by the time I reach retirement, or by the time I reach 60 or 65, I would be able to generate passive income from my portfolio of investments. So that's my own personal retirement goal. You may have some other retirement goals, like you may want to be able to buy, say, a house that is worth 10 million, and aside from that, maybe to have an extra 10 million or 20 million pesos in cash. I mean, these are just goals, but it helps that you have these solid numbers, and from there you do a backward computation of how much you would need to set aside and what type of growth your investments have to generate on an annual basis, and whether these goals are realistic for you, or do you need to save some more. One very important thing to think about before you enter into investments is to first set aside some emergency funds. Okay, the typical advice is for you to set aside around 6 months worth of spending for your emergency funds. This is because, of course, we could run into some unforeseen circumstances such as sicknesses, accidents, or you may end up losing a job and having a hard time finding a new job, or your company might, or you might have a pay cut. So it helps to have some emergency funds that would allow you to maintain your lifestyle, even though you may have to stop working for a little bit. Okay, the next step to achieving financial fitness is to understand where your money is going. One of the important things to do is to create a budget that includes necessities, required expenditures, discretionary items, and other periodic savings necessary to finance your long-term financial goals. So I think what I'd like to emphasize here is the savings necessary to finance long-term financial goals. If you read the book, The Richest Man in Babylon, it always says to pay yourself first. So I think, when you create your budget, and of course, that will be partly based on the goal that you have set for yourself. Like how much would you want to have by retirement, or, what's your aspirational number? You have a monthly investment budget in mind. I think that is what should be a non-negotiable as far as your budget is concerned. You set that aside first, pay yourself first. Then after that, compute for your required expenditures, like the amount you spend on food, on, say, housing, electricity, etc. And only when there is something left over do you spend them on discretionary items. By discretionary items, it means if you want to spend a little bit more on more expensive food, or on going out, or watching movies, or on subscriptions, then you have that extra budget to do it. Otherwise, you should just stick to the basics. Okay? Okay, track your spending and compare it regularly against your budget, and make changes to your spending habits where necessary. Actually, some of us, the problem is we set aside the budget, but we don't follow it. Um, maybe you could download an app that will actually help you in achieving these budgets. And it helps to see what are some of the mistakes that you're doing, why you're not meeting your goals, no? For example, you could actually be buying too much um, handcrafted drinks like frappuccinos. Those are very expensive. So if you don't have enough funds for investing, then maybe you should consider reducing the number of times you go to Starbucks to buy coffee, and actually make your own coffee at home or in the office. Or maybe you eat out too much. Maybe you should consider making your meals at home. Or maybe you just like to go online shopping, and when there's a sale, you're always tempted to buy something. So maybe you should actually avoid browsing those online websites so that you will not jeopardize your saving plans. Okay, so it kind of helps if you can see it on a monthly basis, like how much you really are spending and where the money is going. And use the knowledge and skills you gain over time to spend less where possible and save more. So I guess on a month-on-month basis, when you do this analysis, you will have an idea on where you actually can make some sacrifices and not even feel it, so that you can actually save more for yourself. And of course, which types of products you should invest in so that you earn better returns. Another step to achieving financial fitness is to manage your debts. Okay, as much as possible, do not use debts for the purposes of consumption, especially when trying to optimize savings and investment capital. Of course, these debts are not free and they cost us a lot of money. So instead of allowing us to save more, we actually end up spending on paying interest. Okay. Um, okay, so one of the things that people should be aware of is high interest rates. Okay, on personal loans, especially credit card debts. I think credit card loans would have an interest rate of around 3% per annum, and this 3% per month, and this is actually compounded. It's not straight line 3%. So on an annual basis, it's not just 36%. It's 3% times 3% times 3%. So it's really very expensive. Okay, to put things into context, a housing loan is probably 6% per annum. Okay, so a credit card debt is around 3% per month. So that's a really big difference. So we actually encounter some questions from people who ask us, we want to invest in the stock market, but we currently have credit card debts. What's our advice? Our advice is, of course, I mean, the returns in the stock market can be volatile, but the cost on your credit card debt is for sure. So if I were you, I would prioritize paying off the debts first before I actually think of investing in the stock market, because a 36% return is, or a 36% interest on debt is really substantial. And if you actually pay down your debt, then definitely, that would be a guaranteed plus already for you. Okay, build a debt management strategy to reduce and eliminate high interest debt and to accelerate the payment of debts. Okay, assuming that right now you already have a lot of debts in your credit card, you should think of a way to pay down these debts. So I think, the credit card would have like a minimum monthly payment that they would ask of you, and it's a really very small amount. I think by paying that, you will not be able to reduce your credit card debts. You have to take a look at how much is your interest expense and pay that amount plus a little bit of the capital, and then stop buying anything on credit cards anymore. Just make sure that you just keep on reducing your credit card debts every month. And maybe going forward, you just buy something using cash on hand, so that at least when that cash is already used up, you will stop buying already. It will help you stay disciplined. Okay, the next step is actually my favorite. Put your finances on autopilot. Okay, for me, putting finances on autopilot is like having a trainer when you run on a marathon. It kind of, keeps you focused or keeps you disciplined, because um, you can't be emotional about it. For example, put money in your savings account using direct deposit so that you don't spend it. Okay, so assuming that you have a payroll account, usually when you see the money in your payroll account and you want to buy something, you just keep on spending it and spending it until there's nothing left. Maybe what you can do is open a separate account where the funds from your savings account will go to that secondary account, which you do not open as much, so that at least that amount is already set aside for investments. Okay, so that would help. At least you don't see that money and you don't touch it anymore. Okay, make sure regular contributions make it into retirement and other investing accounts. Again, when you set up that secondary account, which is supposed to accumulate money for investments, make sure that if you can link it to your broker's accounts, or to the purchase of, say, a UITF or a purchase of a mutual fund, you should do it also automatically, so that there will be no emotion involved, and it will just keep on buying and buying, and investing in stocks or bonds. And also use auto pay to manage and pay recurring bills like mortgages or loan payments. Again, earlier on, for example, we talked about um, credit card debts. And of course, that's something that you want to pay down as quick as possible. As far as mortgage payments are concerned, again, you don't want to be in default, because when you get into default, it will be very expensive for you. So again, if you have such payments already that are required on a monthly basis, make sure that before you even see your payroll account or what's left of it, make sure that this money is already set aside to a separate account for the payments of mortgages and credit card bills. Okay. One of the things you could do is use a money management application to help track payments and other expenditures. I think there are many of these online that you can download and keep on your phone. I think it's very exciting to, I mean, especially for somebody who has a lot of debts, to actually discover that, from one day not knowing when you will be able to pay everything off, to actually seeing them diminish faster and faster. So it is a very fulfilling feeling. Next is to maintain a steady lifestyle. Um, I think one of the things that you will realize is that, you know, how come as your income goes up, you actually still save less, when in fact when you were earning less, you were still okay. I mean, the tendency is for us is that when we earn more in terms of salary, we also spend more, and in fact sometimes we even spend more than what we earn. So even though we get a bigger salary, we actually end up not saving, or actually getting into a worse position. So so that's why it's important to make sure that you maintain a steady lifestyle. Your spending habits don't change even though you get a pay increase. Okay, growth in income, bonuses, and other windfalls should lead to an increase in savings and investment accounts. So I think one of the first things you should do when you get a pay raise or a bonus is to um, set aside 50% of that increase to savings and investment. At least you don't know what it's like to have a much higher salary yet. So it will help keep you from having a more lavish lifestyle, because you don't even see that amount. I think this is especially important for people who have not even started investing yet at this point in time. If you have not yet invested, that's okay. Just tell yourself the moment you get a bonus or a pay increase, rather than think about where to spend the money on, prioritize saving 50% of the increase or 50% of the bonus that you get and other windfalls. Okay, keeping expenditures relatively constant over time is a key method in achieving a secure financial future. Again, the more you are able to save, the faster you will be able to reach your financial goals. Next step is to invest wisely. So these are just some tips on what you could do for you to grow your investment portfolio. One is to establish a well-cost diversified or a low-cost diversified portfolio that's appropriate to achieve both short and long-term goals. I think one of the things that we would like to emphasize is low cost. Okay, so when you are trying to evaluate the different funds that are available for you to invest in, one of the things you should take into consideration is the cost or the management fees that these funds charge you, because the returns of funds are not guaranteed, but of course the cost is one thing that you can control, and they are guaranteed to hurt your performance. So as your costs become lower, of course the returns should improve. And diversification is something that we all also always encourage among all investors. This is to protect your portfolio from too much volatility and to make sure that it's appropriate for both short and long-term goals. Short term, because you may have some liquidity requirements in the short term that you would like to meet. So it's good to have some liquid investments such as fixed income or deposits. And long-term goals, let's say you're just 30 years old and you don't expect to touch the money in your investments until you're 60. So of course, that money can be set aside to more volatile investments like stocks, which provide higher returns but are more volatile in the short term. Okay, use a broadly diversified portfolio to obtain a proper return in regards to your attitude about and ability to take financial risk. Okay, broadly diversified portfolios, I guess it would mean you also have to ask yourself your risk appetite. Okay, and again, diversification is important. You can't just buy all stocks. There has to be a mix of, say, stocks and bonds. And even if you buy stocks, buying just one stock is no good. It's better to buy a lot of stocks, and it could be through buying a mutual fund which is already automatically diversified, no? And then again, the mix of stocks and bonds should depend on ability to take financial risk. For example, if you're younger, you may consider a bigger chunk of your portfolio being in stocks. But when you get older, maybe a bigger chunk of the portfolio is in fixed income because you need income from the portfolio and you can't take as much volatility. Okay, where appropriate, think long term and don't be overly focused on the short term performance of your investments. Stick to your investment plan and review your portfolio periodically to stay on track. Again, I guess, as an investor, we shouldn't be too micromanaging our portfolios. Um, because, for example, if you, as I've said earlier, if you're younger, you should have more stocks in your portfolio. But then again, stocks tend to be very volatile. So that said, you might be tempted to no longer stick to the plan and stop investing in stocks. But that said, don't be too short-term oriented because stocks tend to be volatile, but over time they generate the highest return among the different asset classes, which is why if you're young, you need to set aside a bigger chunk of your portfolio into stocks. Okay, then the next step, which is the last step, is to obtain knowledge and advice about investing. Being financially fit means understanding and utilizing the main principles and best practices in saving and investing. Again, the learning shouldn't stop. It should be continuous so that you will keep on understanding how to improve your investment portfolio. If needed, get the help from an accredited investment advisor that can help you build an investment plan and portfolio to meet your financial needs. Again, um, maybe you can talk to somebody to share with them what your dreams and aspirations are, and are those goals realistic in terms of what you can set aside as savings and investments? Or what type of investment should you buy in light of those goals? Okay, so it helps to be able to talk to an expert who is in a better position to give you advice. Okay, so just a few reminders before we end this presentation. It takes time, energy, and discipline to obtain and hone the necessary skills to be financially fit over time. So again, it's not a one-time thing. Investing to become financially fit is actually a long-term endeavor. that requires a lot of discipline from you as an investor. Okay, that said, the best time to invest or to start investing and thinking about your retirement is now, no matter what your age is. Okay, so that ends my presentation, and we'll open the floor to questions.